Hi guys, the engineer here. Let's begin with today's review and the continuation of previous analysis that I was making on here on the channel. I don't know if you remember that it's important for you to have in your chart these new weeks opening gaps on regular trading hours. That is basically the opening range gap or regular trading hours gap, but only from Friday to Monday each week. And now, today, we are going to add new gaps to our layout. And let's begin. You already know that one of the most important, I think it's the most important level of a candle is the opening of that candle. And since we are trading regular trading hours charts, I think that this specific gap is very relevant. So there are levels of significance of this gap. We have the daily opening range gap of each day, the weekly opening gap, and we have the monthly opening gap and the quarterly opening gap. I think that you really need to have these levels in your chart in a very organized layout to have this accessible to you every day. If you don't want to get lost in your high time frame narrative. Okay, so let's begin with the quarterly candle. Okay, we have here, I have here the quarterly, the weekly, and the monthly chart. Okay, so you can see how we have different candles here on regular trading hours than your electronic trading hours. So I have here on my tree the new NQOG. This is the new quarterly opening gap. This is the NQOG. This is how I have it here. So okay, this is basically April open, the gap that was formed during the transition of the monthly candle, but this is the quarterly opening. And we have here the Q3 begins on July. So I want these two levels differentiated from the others gaps, because if you keep this as a new week opening gap, you really don't know that this is the quarterly opening. If this is a new week opening gap and a regular trading hours gap, but it's also the new quarterly opening. So you can see here how actually from this closing price to this opening, we create a volume imbalance on this candle here, on this quarterly candle. And now we just traded this level to the tick. The consequent encroachment was traded to the tick of this gap. So you can see the relevance of these levels. Okay, I always have the high, the low, and the gap, and the 50% by default. Okay, so now we can add the new month opening gaps, and look, now we have March, June, and today gap was August, the new month. I don't have it in my chart. I will put it later. And these gaps are more relevant than the others regular trading hours gap or new week's opening gaps, because they are high time frame candles gaps opening, and but the final gap is the new week opening gap. Okay, if you use one indicator for this, for example, I have this from Toodegrees. It's my brother, and you can plot this, but look, for example, if you want to plot all this, I don't want this in my chart because it's too much. So you can draw manually there or put less gaps, but I prefer to have it to do it manually. Okay, because you can see it on lower time frames. That's another reason. For example, if you move on to the 15 minutes or 5 minutes, the indicator is not going to plot these gaps because the data is calculated on the actual time frame you are, and you are not going to have these levels in your chart. Okay, so remember on the previous video that I told you that I was expecting on this channel video that below this low, I was expecting to come back to this gap here and retrace to this gap. That's exactly what I told you. And I told you also that we can do this, come back here and reject this gap or use it. If we are going to invalidate this gap, we are going to use it like as an inversion and start to moving to the buy side. But I was because the anatomy of the quarterly, and I will tell you why on the next chart, why I was expecting lower prices. Okay, so if you can see here this price action here on this weekly chart, this is the weekly chart on regular trading hours. If you move on to your electronic trading hours, you don't see this price action here. You see how this is not overlapping these bodies of these candles, and here you can see the difference. Why is this so important? Because we trade this candle close below the quarterly opening. This is really huge. And also we were trading below these two new weeks opening gaps here. So and with the breakaway gap here. So the bias was clearly bearish after we close below these gaps. And we open here and we accumulate more orders inside this gap here, because what I told you in the beginning of the video, the opening of the candles is where fair value is. And this is not really hard to understand, because imagine that you are trading any time frame, any candle, where is the most cheap price that you are going to find on that specific candle is that at the moment the candle begins. That's where fair value is on this candle. So these gaps are literally fair value. So they are going to use these inefficiencies, these gaps, as areas as reaccumulations or to offset positions, like you can see here. You can accumulating, distribution, change the structure, reaccumulation, distribution again at these same gaps. Okay, so the fact that we close below this gap and we open and we close below, what is this? This price is completely balanced. There is no reason to come back here at this gap. Remember that I told you the same now previous video was about on the daily chart. Here it's the same price action. Here, look, we close, we open, we close below this price action right here. There is no reason to move above the 50% of this price action. And we take this previous day high, offset accumulation at 50% of this balanced price range, and start to move up low. This is just, I really don't know how to say it, but this is just too much for me. It's very accurate, precise, this chart. Okay, so imagine that this was yesterday, sorry, this was Tuesday price action, and we take this low here, they offset shorts here, and now they are going to look the price level here, quarterly opening. We are going to come back to reprice these inefficiencies. Okay, we take yesterday that it was high impact news, FOMC, FOMC liquidity high, and price just melt down after all the retail were trying to long, because now we are in a market maker buy model. This is not how it works. We have to respect these gaps first and invalidate it with a body and with narrative and SMTs and many things. But okay, so, and now look, what do we have here? This is ES chart, and look what the ES did. We fully repriced this imbalance right here, this new week opening gap. With the same take liquidity from FOMC, previous day high. This is a valid order block, and price came back again here. And look how they left these lows here. It's beautiful. And for example, here, oops. And look, and we had, this is a how can I say, this is a different kind of SMT. I really don't know how to say it, because this is a divergence between these two assets, but it's not on highs and lows, because ICT was saying that when you have these failure swings, you are creating a divergence, and smart money tool, this SMT. But the fact that we didn't trade this gap and ES did, this is also an SMT, but with gaps. I really don't know how to say it because it doesn't have a name, but this is a kind of divergence. And I was talking about this on my Twitter account, about how to use this exactly behavior, but for intraday charts on the opening range gap or regular trading hours gap. Okay, now if we move on to the 15 minutes chart, okay. So this is the tool that I designed with Toodegrees. This is Dynamic RTH Gap Pro, and I love this tool because basically I don't have to do anything for my intraday annotations. You have these gaps. It's the standard deviations projections that I use also. I will mention right now, but look, all this range here, this is a new week opening gap from this week. I don't have it annotated right now, but this is a new week opening gap, the closing price from Friday on regular trading hours, and the opening of Monday. So we are trading, let's do it. This is a close. The opening and 50% of this. Okay, here you go. You can place a label here. Let's put actual on this to differentiate. Okay, so this is from let's change it to this. Nice. I think this is fine. Okay. Beautiful. So yes, Monday price action. We had SMT. Here on this day, and these highs, you can see here, look. So on this SMT, they on Tuesday they move the market to the sell side without coming from these gaps and taking buy side. This stops right here. This is a clear sign that they are using this as a inducement. Okay, and note the bodies on this monthly opening gap, and this is the quarterly opening gap. Note the standard deviation from this day, 4 standard deviations, and new quarterly opening gap and 50%. This is nasty precision. I took one long here on one paper trade and one trade at the open here. around here on the 5-minute CSD here, and I offset the trade around here on this high here, yes, at the 3 standard deviations and this high here. So let's continue. We offset the shorts below this all low as a total sub entry, offset accumulation here, and they accumulate or unload the shorts right here. And all this gap, if you move on to electronic trading hours, all this price action is just inducement. They use electronic trading hours to place a sentiment in the market, but the big dogs playing this game, they are not trading electronic trading hours. I told you before that if you want to buy stocks or anything at CM on the stock market, there is only available, the market is only open from 9:30 to 4 p.m. So you can use on this tool trading, bringing to the top, and now you can see here. So all these overnight price action, they were moving higher at the opening of this day. They came back to this retracing this in this candle gap here, close above the gap, move higher, 2.5 standard deviations, retracement into the gap, reaccumulation at this order block, and moving to the buy side now. And the market closed with this candle. I think that 2 weeks ago I made a tweet about the relevance or importance of the last trading hour of the market. This is something really important and crucial. Why? Because when the market opens at 9:30 opening, they are going to refer always at the previous day close. They will try to pair their orders with the stop rate or a buy side liquidity or an imbalance or an order block or a breaker or a key level of the regular trading hours gap, but they are going to refer to these specific times. They don't care this price action. Believe me, you will start to realize this once you start to study this chart. Okay, so look how they just touch the gap, but look, imagine all the sellers on this day. Okay, they take this previous day high on regular trading hours, and when the market closed, there is no need for the smart money to order pair below outside of this time range. They did it on regular trading hours gap, and they are going to push the market on electronic trading hours because you can place trades, you can buy or sell stocks on that time. These guys, I don't have words for these guys, but this is just a rigged game. So rest above this high is resting buy side liquidity or stops. Did they take this liquidity on the close on Wednesday? No, they didn't, because they were waiting at the next day open to do it like today. So we have now the liquidity from previous day close, this is stop rate, and the buy side liquidity from this day. And we have 4 standard deviations from this gap, 3.5 standard deviations from this gap, and half standard deviation from this gap. So there were many confluences on this trade, and we were premium relative to the regular trading hours gap from today, Thursday. So they pushed aggressively the market at the opening, order pair the positions here, and the fun begins right here. They start to taking all the positions from the guys that were buying on CFDs and electronic trading hours here. These guys are really they don't have, they are going to destroy you if they can. Okay, and look, where do we close? Inside again of this new month opening up, and in the lower quadrant of the regular trading hours gap today. And note where they accumulating more shorts. What is this gap? This is, I will change this. This is Monday, new week opening gap. Look, and we have here, this line here is the upper quadrant, the 25% of the gap. So we have 25% of the gap, consequent encroachment of the new week or actual opening gap. We close below this previous opening gap, come back again, and the price move lower. Beautiful. This is ES. It's the same logic. They took previous day high or previous PM session high here, and they fully closed these gaps. Here, this is a new week opening up. These lines here from 19 July and 22 July. This new week opening up, they fully closed this gap here. You can see, and we have 3.5 standard deviations from these gaps. Sorry, and they took this as an offset accumulation right here, and took all the liquidity from electronic trading hours here. And the same, look, this is a previous new week opening gap, 50% consequent encroachment and an imbalance of the 15 minutes chart. Close the gap and come back low. And now the algorithm is working on electronic trading hours. I don't care. Another thing. This is sauce also. let's move on to the 7-hour chart. This is my daily chart, but regular trading hours. Okay. When you have these breakaway gaps, you want to see the standard deviations of these gaps. I have it on my tool. You can see how we have automatically and this is, I will change the color and you can see, okay, we have 4 standard deviations here, and from this gap the 4 standard deviation is right here. So this is a key level that we want to see. Let's see if we want to take these levels, because look all the gaps holding price right here. This is a quarterly opening, new month from March opening gap, and we can come back to these gaps, and from here taking this for example all this liquidity from here, and on these gaps we can see a relevant move. Maybe we can start now to move higher, but I really don't know this. Let's see what price does, but for now 7 hours chart. This is from, I will take this, all these lines, and I will place it inside of my new week opening gap here. Take it off. I don't want to see anything. Clean chart. No. Let's see the standard deviation. This is a closing price. Remember, closing to open price. Okay. Place your standard deviations. Closing price here. And open. Sorry. This is opening, close. Yes. Okay, this breakaway gaps on regular trading hours. So this is a target level relevant from these gaps for standard deviations, and 2.5 from this. So this is a retracement area on this gap, and taking partial or offsetting positions from this move from here, from this gap right here. 4, come back again to these levels, and now we are moving to see if we can reach these levels right here. Okay. So this is everything for today review or price action. I didn't move even to the 1 minute chart today because I was expecting this huge move today, and I have one thing that when I in really low time frames, it's hard to hold positions. I can trade seconds chart or minute chart, and lately on the past months or weeks I was putting much attention on seconds chart, and it's fine if you really know what you are looking for. But I was thinking this: we are trading on the quarterly, the Q3 and Q2. These two specific quarters of the year are really good for this kind of trades. I think that when you are expecting like consolidations or not big days or big expansion days like today, you can trade that little lower time frames. But it's hard to see the expansion of these moves on lower time frame because you get FOMO. I don't like it. So the past 2 weeks I've been trading on a little bit more higher time frames, if you want to say, like 5 minutes, 1 to 5 minutes, and today the trade I executed was on the 15 minutes chart, and it was much easy for me to hold the trade. Okay. Yes. So this is everything for today review, or yes, for today's review. You can study these new weeks opening gaps, new months opening gaps, new quarterly opening gaps, and combine these with these intraday opening range gaps during the week, standard deviations projections from these gaps, liquidity resting above all highs, all lows, session lows, highs and lows on. So, and you will find a very good logic for your trades. Basically, if you saw my first video on this channel about the introduction of this regulatory hours dynamic gap tool, this tool, basically you want to short above this gap. Why? Because if you think that this is the opening of the daily candle on regular trading hours, this is where accumulation, manipulation, distribution, so this is AMD, or power of 3. So imagine how can you trust this kind of longs here if you have this gap here, buy side liquidity, and you have these gaps, this huge gap, and the narrative, you are closing below this quarterly. This is a quarterly new week opening gap. You are closing below this gap. So I can just long above around here. I just can't. I can't, because I understand that if I want to long here, I want to long in discount, and discount is around or below this opening range gap, where you can long here. Why? You are trading below the new week opening gap from this week. This is discount. You are taking liquidity, sell side liquidity from here at a relevant new month and quarterly opening gap. This is fair value. This is where they are going to offset the short and accumulate more to take these shorts, these buy stops resting above these highs right here. this is where you can look for longs, not here. You can do it on little on second chart, for example, and a market maker buy model on a 5-second chart. I think that I saw that today. Okay. You see? Had an SMT, lows, and this is the opening range gap from today. SMT at the lows. This is not. This is ES. Let's move on. You see, they move to sack the open just right to the buy side, and it's hard to move. Yes, right here. Here, you see, this is an SMT. They are moving just here, buy side, and on Nasdaq they took these little sell stops on the second chart. And where they were accumulating more. Look, this the 50% of today gap. You can trade second chart using this same logic for intraday. And look, this looks like a monthly range on the 5-second chart, and it's insane. If you can trade this chart and place tight stops on these candles, you can trade really good. But on these days that you see those 50 points in 2 minutes, for example, we have 2 minutes and 35 seconds, 60 points. It's hard, really hard, but the logic is the same. Okay. So this is everything for today, guys. I hope you find this insightful in your trading. If you want to trade with this in mind, with these gaps, logic, and RTH charts, you must have this in your chart. Don't be lazy and make your annotations and backtest and journal every day this. Okay, see you next time. Stay safe.